time for our quarterly chat with the top management of TCS. They've officially kick-started the earnings season. The top team joins me now, the CFO and Head of HR, Rajesh and Ajoy. Gentlemen, Happy New Year to both of you. Thank you for joining us.
Happy New Year to you and your visitors as well.
Thank you very much.
You
Rajesh,
as well, yeah.
the communication from the TCS management in middle of Q3 was that Chennai will be a problem and Q3 will be a quarter of unusual volatility. So expectations were low. But on diluted expectations also, most of the brokerages are saying that TCS has underperformed.
There's no taking away from the fact that it's been lower than expected, both at our end as well as from the market perspective. But I would like to draw your attention on, in terms of, got to look at it in parts, because it has been significantly lower, primarily drawn down by the weakness that we have seen in India. But in our other markets like the US, UK and Europe, we see structurally it's still fairly stable. There is a slowdown, but growth is there. And we see growth across our key verticals also. So both at a core market, geographically and vertical level, the growth momentum continues. Definitely there is no acceleration, but I wouldn't see it as a structural breakdown of the growth momentum.
I'm going to keep the Chennai part aside. That's something which is natural and that's something which we can't, hopefully it will not repeat. But what about other aspects? Furloughs, India business. What went wrong in Q3? What was so unusual about your regular business?
I wouldn't say what went wrong. India, we have been warning that India is volatile and we are not seeing enough investment on the ground, and we are downstream players in India. So unless the actual investments start flowing, our participation remains low. So this was, the volatility was unexpected, but to some extent the weakness has been in the making for some time. The furlough side of it is also, it is not structurally any different, just that the intensity might have been slightly more this year. And coming from, again, I think globally everybody expected a much better year than what it is turning out to be. And we are now so integrated with the larger economies that we will also find the same the impact coming through. So I wouldn't really characterize it as something that went wrong over and above the ordinary. It is about the intensity being more than what was expected.
But if I look at rough numbers, you've reported numbers for 9 months for FY16. One more quarter to go. Q4 will be slightly better than Q3. That's been the historical track record. If I consider that as well, the exit rate will not be that impressive.
We'll have to wait and see where that comes. Actually, Q4 last year was actually a bad quarter, but typically we have done better in Q4. So we are at a period of time where it is difficult to call forward too much, and I would rather wait for budgets to become more visible in the February-March time frame, and then talk about it as part of our Q4 commentary, and we should have a better view of where the world is headed to.
Okay, I'm going to come back to the basic macro, outsourcing our environment once again. Ajoy, there is good news and there is bad news. Good news, which is that attrition rate is down from the peak, but it is nowhere close to what your historical averages were. So are you headed there?
See, the direction is absolutely correct, which is from 16.2 we have come to 15.9 as far as last 12 months is concerned. But I think more than that, if you look at the quarterly shift, which is much more evident, which is from 17.1 to 15.12%, because 0.5% in this particular quarter it has come down. So I think the direction is right, the trajectory is right, and the engagement activities that we are taking from different HR initiatives, from business point of view, from direct supervisor to people initiatives, the kind of initiatives in the digital training that we talked about, announced, all that is actually helping in controlling our attrition. So I think the trajectory is right, and we would definitely like to bring it down below where we used to be earlier. So we are heading towards that.
So the number you shared with us yesterday at the press conference was that you've trained nearly 70,000 employees on the digital platform, 30,000 more to go. So what changes?
See, from a digital point of view, it is what we have said is default is digital. So everything is becoming digital, and it's preparing ourselves towards that kind of traction that we are seeing with various customers. So each and every individual needs to understand digital in order to provide services or in order to meet the customer's requirements. So unless and until they appreciate the technology, unless and until they have the kind of depth that is needed, it will be very difficult for meeting the customer requirements. So that is why we said that everyone has to go through this. And it's not that this is the only technology shift. We have done technology shifts before, but this is much more pronounced because this will impact each and every individual. And that is why this initiative of training almost everybody, we said 1,000 in this year, and we are pretty much on course as far as that is concerned.
Do you think your digital growth really saved the day for TCS? 4% sequential on a decent base now. It's not a small base, it's a large base. That did the trick for TCS?
It's not about doing the trick. I mean, that's the way it's going to be going forward also.
So you expect a 4% sequential growth?
Excuse me. Not necessarily saying that, but definitely digital growth will lead service line growths, because that's where the technology change is going, and it's a inevitable and irreversible change. It's only its momentum that will keep varying on a Q-on-Q basis or a period-to-period basis. But we are now very definitely down that path. So we recently did an internal symposium on the various projects that we're doing in digital across verticals, and the extent of penetration that we're seeing, because earlier it was retail and BFS, but now it's right across. So practically every single vertical industry, there are significant projects that we are doing currently across the digital stack. It is still at a project level. It is still not enterprise transformation-led, re-architecturing-led, large program-led spend. It is still project spend, but it is amazing the speed at which it is permeating through the whole thing.
So a sequential growth could be 5, it could be 4, it could be 3. That's variable. But directionally, the business is going to be reporting a very smart growth.
Absolutely.
Is digital a high margin business?
Digital is, we don't call out the margins in it, but remember that in our industry, any new technology typically comes in at a margin point which is lower.
Okay.
And then the margins improve as scale improves. So especially as you go from small projects to large programs, the margin management becomes better. And also in the initial phase, we are still in the investment phase. Later on, as that stabilizes, the margin management also improves. So if you see it in its life cycle, digital will definitely be a higher margin business than the next 5-year life cycle of the traditional technologies.
So what's that tipping point beyond which you would say that, look, my new business has taken over, old business is getting diluted? Digital is about 13% broadly, which means old business or traditional business is still higher than digital business. That migration is coming. It could happen in 1 year, 2 years, 3 years, but that migration is coming.
It's an ongoing migration. You should think about it more as liquids mixing rather than things. So what we call as traditional business ADM today was what we called e-business 10 years back or 7 years back. And it is not that we consciously changed it from one to the other. So 5, 6 years later, what we will call ADM will essentially be what we are calling digital today. And that's in the nature of our business. In fact, it is this is the thing that gives us the momentum. Because if technology change were not to happen, then our existence itself would be in threat.
How bad is the India business?
That's a tough one to call, because there are two parts to it. One is that our India business is not as much an outsourcing business as it is a system integration business. So it has got the ebbs and flows of when a project starts and when it ends. So part of this quarter is also because of that new projects did not start up as much as the old projects are coming to an end. The other part of it, of course, is the demand that we see. The demand side is weak. We are not seeing.
Is the CMC demand you're talking about?
In CMC, we have gone through a bit of restructuring in terms of the nature of businesses. Certain businesses that CMC were in, we have not necessarily renewed it as we align it more closely to the TCS businesses. So that weakness is also playing into this quarter. But between CMC and TCS, I'm not differentiating in terms of future demand. I'm talking about overall aggregate demand across both public sector and private sector. The volume of demand is low, and therefore it will stay muted till we start seeing that.
So the India business will be bumpy.
It will be bumpy. In fact, it's a surrogate to what is happening on the investment scene in India, because unless fresh investments get triggered, nobody is going to significantly invest into IT.
But the markets are taking notice of the visa problems, and my understanding is 2016 is the US presidential election. The visa rhetoric will only pick up more and more, have high decibel, anti-campaigns. As of now, there is no problem. That's my understanding. But is it time to be careful?
See, from a visa point of view, the only thing that has happened is from a cost aspect, the visa fees has gone up.
Yeah.
but at the same time there are different kind of regulations which are there, but some of that we are watching as to where things are, and we will plan accordingly, and we have our plans in place. So we'll have to be very careful as to which way things are going. But at this point, we are not very. Things are very much similar to where we used to be. So there is not much of a change at this point in time.
The US jobs data seems to be indicating that the US jobs market at least has stabilized. This was not the case 2 years ago, 3 years ago, 5 years ago. So one would imagine that if US unemployment market has stabilized or US job markets has stabilized, the visa rhetoric may not be that strong.
Probably we'll have to just wait and watch as to where it is, and given the election year, it will be very difficult to comment on what kind of issues are brought up. But the bills that are there, some of that has died up, has gone away. Some of that has come back again as new bills. So we'll have to wait and watch as to what happens. But yes, the job situation is better than what it used to be, and some of that is getting reflected in our growth as well as in US. So
walk us through the hiring plan. That is the only guidance number which you officially share with us.
Yeah, so the only thing that I can say is hiring as far as this year is concerned is we are pretty much on course. We said 75,000, and if you look at what we have done so far, it's close to 67. So we are pretty much on course on that. And as far as next year's campus is concerned, we are also on course. We said about 45,000 is what we will hire. And now rest of it as to what will be my total hiring as far as next year is concerned is still to be worked out. We are in the business planning phase, which will probably go on till about February, March, and that is the time when we will announce what our total hiring numbers are going to be.
But you'll stick to a bare minimum hiring at least.
So we will hire based on our business plan as to what we need, where we need, which particular technology do we need, and it's a very detailed kind of planning that we go through, and it will be to meet our business demand and also to build capability for any investments that we want to make for our own internal product development and everything else. So it's a pretty laborious kind of an exercise that takes time.
Chandra, welcome back to ET Now. Happy New Year. Thank you for joining us.
Happy New Year to you, Nikunj.
Can't say the same for your numbers, can I? It's not been a great year. It's not been a great quarter.
It's been a tough quarter. We had to some extent anticipated it will be a tough quarter, and it became tougher because of a couple of additional headwinds that we faced during the quarter. But I still think that given the conditions, while the number footprint may not be good, if you look at the metrics, I think the metrics are credible, because I believe the international revenues have done well at 1.1% on a sequential basis. US has done well at 1.4%, and Europe has done well at 2.5%. Then if you look at the verticals, all the verticals have done well. We've had a more than expected dip in India. So I think those headwinds have been there, but the footprint overall is good, and our margins have been credible, because in a quarter where we have had such a low growth and we've had extra costs, still we've been able to deliver 26.6%. Our cash conversion has been exceptionally good. So I think the overall operating metrics are all good. So that's the positive I take away, but no escaping the fact that numbers could have been better on the top line.
Okay, let's keep the Chennai aspect aside. That is something which is natural, not man-made. But were there any business issues which cropped up which you were not anticipating in Q3?
I think the India domestic business,
that was the big one.
That was a big one, because that almost contributed 0.6% hit. Yeah. We did expect that India will not do well this quarter, but it was more than what we...
Your India business has come down from about 12-13% to less than 5-6%, about 6% now. 6%
yes.
now.
Yeah.
Is there a conscious strategy to cut it down more?
Definitely, there's a conscious strategy to do two things. A, don't get into contracts which are difficult to execute and we can't make money, definitely. B, anything that adds to the volatility, we are wary of.
So
we don't want one-offs.
So Diligenta has been adding to the volatility, but in your own words, that problem is getting over now and one more quarter more. So once Diligenta stabilizes after one quarter, what changes?
I think Diligenta will not have a degrowth. See, I think if you look at our BFSI segment, BFS has been doing well, even in the tough periods. The banking and financial services has been doing very well. Insurance, we've had a tough several quarters now, both on the services side and on the Diligenta side. On the services side is more or less stabilized now. We don't see a drop in revenues. It will continue to pick up growth from here. And the Diligenta side will get settled at the end of Q4. After that, we don't see a drop in revenues. It'll at least be flattish, if not growth. And if we get some closures on that platform, then it will show growth.
So LATAM has stabilized, Diligenta is about to stabilize, Japan will be volatile. That's the broad commentary.
Yes.
Let me draw your attention to what is the stock market verdict. I'm not getting into stock market performance, but I'd like to draw your attention to the P multiples. The P multiple for TCS stock, they've contracted from about 25, 26 times to about 17, 18 times. And there seems to be a messaging from the market, not a particular analyst, that maybe the peak rates for TCS are behind us. Maybe they're worried about future. Maybe they're worried about digital transformation. How would you like to defend that?
I think, digital has been doing very well. In fact, for the past several quarters, I think we are seeing a tremendous uptick. We believe that we have the best credentials, and we see that in the traction with customers. And I don't think that we'll be left behind in digital. We'll be ahead of the curve, and we see tremendous opportunities in digital, and we will fully participate to gain huge share on that business. Whether it is in analytics, whether it is in Internet of Things, or digital marketing, or cloud. I think we have all the partnerships. We have this strong partnership in the startup ecosystem as and when it's required. We've got a strong partnership in the cloud ecosystem, and we've got capabilities. We've got our design studios, and we've got our digital learning platform. The employee retraining has been happening at a rapid pace, and we are a digital partner for many top clients. So I think as the volume picks up in the digital business, TCS will play a significant role, and all our core markets are doing well, and all our core industries are doing well. So there is no reason for any kind of concern on the future. I think TCS will continue to do exceptionally well. It's just that sometimes you get hit off, and then you don't want to repeat. You don't want to have those repeat one-offs. So I don't want to get into saying this reason or that reason, but the point is that we've had one-offs, and in new areas where we've had markets and so on, so which I think should be behind us. So I don't think there is any concern.
Why do you think these one-offs will not be repeated?
Because all these known things, I've explained to you why. You've seen Latin America come off, and I think Diligenta will come off next quarter because we know the projections. And Japan will take time. Japan is more a story that it should kick growth. That I want to wait some more time before I can give any positive commentary.
Oh, 4% sequential growth in the digital business, that's impressive. That's very impressive. Markets are undermining it, but it's a large base now. So can I assume that the growth in the digital business will be on a similar run rate in coming quarters? 4 could become 5, 5 could become 3, but directionally the growth momentum is strong.
Absolutely, there will be a strong growth momentum in digital going forward.
There is a huge technology migration which currently is happening in the Indian IT industry. Typically, when technology migrations they happen, they start at a lower margin, and then margins they move up because of economies of scale. So what is that tipping point beyond which you would say digital business is the big one?
I think the way to look at it is that we have said our target margin range to be 26 to 28. We're pretty comfortable in operating in that range. So we will leave it at that. There may be opportunities where we can get higher margins, then we'll reinvest it. And we don't see a downside at this point in time. If we see concerns that we can't maintain the margin, we'll come back and recalibrate it. But at this point, we're pretty comfortable in remaining in that range.
This margin range was shared about 2 years ago. And what has changed in last 2 years is this whole digitization of the world now, the SMAC opportunity.
So let it take off in a big way, then we will see. See, because in digital there are two different types, right? One is the services business where we are advising clients and designing and delivering the transformation. That's one set of opportunity. The other opportunity is our platforms. If all our platforms scale, there will be a huge margin uptake. But we need to wait for that.
When will that happen? Because I was about to ask you that question.
If I know, I would have told you.
But how much are you investing in platform growth?
So we've got a number of platforms we have launched, and I spelled them out yesterday. We have got our Ion assessment platform, our Chroma platform, TAP for procurement platform. Then we have our intelligent urban exchange for smart cities. Then we have customer intelligence platform for telcos, customer intelligence platform for financial services. Then we have launched our platform in big data. So there are many platforms we have launched, and Ignio. So all these platforms are winning clients now, and we've seen good traction. But the thing is, we need to scale. So I'll wait for some more time, and once they start contributing materially to incremental revenues, which I think they will, then it's easier to quantify.
It's less than 5. Platform business is less than 5% of the total business.
Yeah.
It's very less, right?
Yeah, very less, right.
So what will move the needle for you? We must also, our viewers and some of our shareholders, they must also appreciate the fact that, TCS is a large company now, $15–16 billion. You need to do something special, something out of the box, which could really move the needle for you.
I think, let's step back and look at a larger picture. I think, we have been at a double-digit growing on a constant currency basis, and investors are used to TCS delivering mid-teens. Yes. And that has come down, and that has come down last year primarily because of the 3 or 4 areas I talked about. Once they are fixed, there is still a big opportunity. So I don't want to say what will move the leader to get every 1 percentage point, but we'll wait. It will play out. We'll see.
So if I'd like to take the clock back. When we were discussing your Q2 numbers, out of 5 concerns, only 2 concerns were left. Now, out of those 2 concerns, only 1 concern is left, which is Japan. But rest of the business, the environment, the order book, everything is looking robust.
Yes.
What could be the risk apart from Japan for TCS for next 12 months?
Anything I know, I've already told you. Anything I know, I will know in the future, I'll tell you. Because, I said, 2016, New Year didn't start well for the global macros. So probably I don't remember any New Year with such a headwind for the financial markets, right? But I don't think that should affect our business at this point in time. But having said that, we've got to watch.
But frankly, global macros have not affected your business in history as well. So why that cannot be a reason or an excuse?
That's why I have not said it as a reason. So, but we've got to watch, right? So if anything comes, I'll tell you. But as of now, no.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.